Yes, sure. Thank you so much. So students, how are you all? Any problem, any confusion? Anything you want to consult on? Everything is fine. Students, in our last lecture, I have given you few questions to be done from the revision kit. Did you try to do those? Everyone? Tell me honestly. Everyone tried? Few questions. And did you find any kind of problems in those? No problems? As if I tried all of the questions, is it? Most of the questions. And were you okay with solving those questions?
Some questions are
difficult, but you tried and you are now getting the concepts of it. Okay. Students, what you have to do after every 2 weeks, you have to brainstorm by yourself. You have to revise all the concepts by yourself. Sit alone for 20 minutes, 30 minutes, close your eyes and think what you have studied in 2 weeks. Okay? Just try to make your own mind maps. This is one kind of the revision. You know, before to some time, we were having small revision kits or what we call them passbooks or small books have been issued by ACCA, in which they used to include mind maps. So instead of purchasing those, I never purchased them, but students used to purchase them. Instead of purchasing them, instead of spending extra cost on them, you can make your own mind maps. You know the maps, the flow charts which I'm making over here as well sometimes, okay? So try to make them by your own. So those will be helping you a lot towards the end when you are going to revise the concepts. Moreover, up till 15th of May or 20th of May, we are going to finish all of our syllabus. And in remaining 1 or 2 lectures, we are going to do the revision in class. I will be giving you one set of notes. I will be including few questions in that from all of the topics which we are going to study. And we are going to solve those. But apart from that, I request you that do the revision kit questions. Whenever I will be giving you to them, giving those questions to you, please solve them. Okay? Do not skip those. Do not think that we are going to have time to solve one by one all of the questions which are present in the revision kit, which is obviously not possible. We are going to have activity classes in which we are going to do few questions from each of the topic which we are going to study right now in the class. So if you are having any kind of confusion, any queries, which are very normal to be having, do not be hesitating anyway, and do try to ask your questions, okay? Okay, Samina? Okay. Now, students, in our last lecture, we had started the discussion as per Ifrs 5. Ifrs 5 is non-current assets held for sale and discontinued operations. Sharifa, in our last lecture, you were not present. We had discussed about IS 36 impairment, which is very important from exam point of view. So try to cover that from the recording, but if you still are not understanding anything, you are most welcome to come to my office. I will be explaining that to you once again in a summarized way. Anyhow, so in our last lecture, we started the discussion as per Ifrs 5, but we did not complete it. So from the start, we are going to study it right. Ifrs 5 is assets, non-current assets held for sale and discontinued operations. Ifrs 5 is covering two things. One thing is non-current assets which are held for sale during the life of an organization. We do know that primary purpose of the non-current assets is to be used in the organization to generate economic benefits. We do not purchase the non-current assets so that we can sell them and generate economic benefits or for capital appreciation. Both of these are not the basic purposes of purchasing the non-current assets. The basic purpose of purchasing the non-current assets is that we are going to use them within the organization and we are going to generate economic benefits by their usage. Say, for example, plant and machinery, furniture and fixtures, property, plant, or any kind of equipment which we are purchasing in the organization to be used in the organization is the primary purpose of the non-current assets. But sometimes the situations or circumstances just come in the organization where we are required to make a sale of those non-current assets. So during the life of an organization, when the non-current assets are being opted for sale, we have to recognize them and measure them under IFRS 5. So the first portion which IFRS 5 is going to cover is for non-current assets which are held for sale. The second portion which is covered by IFRS 5 is for discontinued operations. There are few operations in the organizations which are discontinued during the life of the organization. Discontinued operations are going to cover any separate line of a business, or say, for example, in a full restaurant chain, we have one restaurant which is going to be closed. Or say, for example, if there is a full university, one of the branches is now opted for sale. So this is now going to be called as a discontinued operation, which is closed during the life of the business or is being opted, or the management is having a decision to make it sale during the life of a business. So IFRS 5 is going to cover both of these areas, non-current assets held for sale or the discontinued operations. How are we going to account for it? In this chapter, we are going to learn about these few things: reporting of the financial performance under IFRS 5. If there is any non-current asset which is held for sale during the life of the business, how are we going to account for that? Or during the life of the business, if there is any discontinued operation, how are we going to account for that? So this is what we are going to learn in this chapter. IFRS 5, non-current assets held for sale and discontinued operations. First, we are going to learn about their definitions, which can come in the objective type questions. Then, what is the meaning of held for sale? What is the measurement of non-current assets held for sale? And how are we going to measure the discontinued operations of the organization? So this is a very small chapter, and from examination point of view, maybe 3 to 4 marks are going to be covered out of this time. But it is going to come in the exam, okay? So what is the objective of IFRS 5? As we have discussed, IFRS 5 is going to tell us about the recognition, measurement, and de-recognition of the assets which are held for sale and the discontinued operations. IFRS 5 tells us that if any of the asset is fulfilling the requirement to be held for sale, then we have to present it separately on the face of the balance sheet. What does IFRS 5 say? That if any asset is fulfilling the conditions to be held as a sale item, then we have to present it separately on the face of our statement of financial position. We are not going to mention it in a normal category of the normal non-current assets of the organization. The first requirement of IFRS 5 is that all those assets which are held for sale has to be mentioned separately on the face of the balance sheet. At which price we are going to mention those assets which are held for sale? We are going to compare two values: carrying amount and fair value less cost to sell. Fair value less cost to sell is which thing? NRV. Whenever we have to measure our assets which are held for sale, we have to compare two values: carrying value and fair value less cost to sell. Whichever is lesser, at that amount, we have to write our value of the assets held for sale on the face of the. So this is all about assets held for sale, recognition and measurement value. Now come to the discontinued operations. As far as discontinued operations are concerned, IFRS 5 requires us that we have to present their results separately on the face of the statement of profit or loss. There are two kinds of the operations in the organization. One are the continued operations and the other are discontinued operations. The results of the continued and discontinued operations have to be presented separately on the face of statement of profit or loss. As a one-line item, the profits or the losses from the discontinued operations are going to be presented on the face of the statement of profit or loss. Consider that you are making an SOPL. You are mentioning all the items: revenue, less cost to sale, gross profit, admin expenses, selling expenses, and you are reaching net profit, say for example. You are going to do that in the same way. It is for the continued operations. Then after calculating the net profit for the continued operations, you are going to write one more line item, that is the net profit or loss from the discontinued operations. How are you going to reach at the net profit or the net loss of the discontinued operations? You are going to show it in the notes to the financials. Obviously, the profit or the loss from the discontinued operations is also going to be calculated in the same way: revenue minus cost of sales, etc. But the details of the discontinued operations will not be mentioned on the face of the SOPL, but in the notes to the financials. So this is the overview of IFRS 5, and this is a very small standard, and it includes whatever I have told you. Now we are going to see from the book. They say the objectives of IFRS 5 are to set out, number one, requirements for the classification, measurement, and presentation. Classification means that how are we going to classify them? How are we going to categorize them? Measurement means that how much value we are going to put against them. And presentation, wherein the financial statements, they are finally going to be presented. So requirements for the classification, measurement, and presentation of non-current assets held for sale, in particular requiring that such assets should be presented separately on the face of statement of financial position. So assets which are fulfilling the criteria for held for sale, they are going to be mentioned separately on the face of the SOF. The second thing, updated rules for presentation of discontinued operations, in particular requiring that the results of the discontinued operations should be presented separately in the statement of profit or loss. And in regards to the discontinued operations, IFRS 5 tells us that the results of the profits or losses which are obtained from the discontinued operations, we have to present them separately on the face of SOPL. Yes, dear?
Can you explain the flow?
First one is in regards to the assets held for sale. Once the criteria to mention the assets as held for sale is being met, then we are required to mention them, to present them on the face of the balance sheet separately. This is what the first point is telling us. Requirements for the classification, measurement, and presentation of non-current assets held for sale, in particular requiring that such assets should be presented separately on the face of the statement of financial position. So non-current assets held for sale, in a short way, let me explain it once again. Non-current assets held for sale are going to be mentioned separately on the face of the balance sheet, what amount we are required to put for them, lesser of carrying amount and fair value less cost to sell. And for discontinued operations, we have to write them in a separate manner on the face of the statement of profit or loss. So this is IFRS 5. Okay, now, what is the criteria which has to be fulfilled in order to classify the assets held for sale? Classification as held for sale. An entity shall classify a non-current assets as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. So IFRS 5 tells us that what are assets held for sale, these are the assets which are going to be sold in order to generate economic benefits, but not used in the organization. Normally, the assets are being purchased to be used in the organization and to generate economic benefits. Once the assets are going to be sold, the management has made a mind to sell them and recover the economic benefits, then they will be recognized as the assets held for sale. So that is what they are telling. An entity shall classify a non-current asset as held for sale if its carrying amount will be recovered principally through a sales transaction rather than through continuing use. Students, what is a carrying amount? Who is going to tell me? Rab. What is a carrying amount? Yes. No. Aisha? Asif? Very good. Students, at this level, it's must for you to be knowing that what is a carrying value. Cost minus accumulated depreciation is carrying value. Anyhow, for this to be the case, the following conditions must apply. What are the conditions to be fulfilled in order to recognize an asset held for sale? Here are the conditions being given. The first condition is the asset must be available for immediate sale in its present condition. When the management has once made a mind to sell the non-current asset, then the asset must be present for its immediate sale in the present condition. Okay, we do not need to renovate it, we do not need to change it, and its present condition, it is available for sale at any time. If the buyer comes to the organization, we should be in a position to sell it immediately. So this is the first condition. The sale must be highly probable. Now, probability is a normal English word, but in accountancy, probability means when the chances are more than 50%. Okay. So the sale must be highly probable, meaning that now, how are we going to ascertain that the sale is probable or not? We are going to ascertain it when management are committed to a plan to sell the asset. Management is having a strong intention to sell the asset. The second one. Good morning, then. So the sale must be highly probable, meaning that management are committed to a plan to sell the asset. This is the first condition which is going to tell us that whether the sale is highly probable or not. The second one, there is an active program to locate a buyer. Management is continuously striving to search for a buyer. Then the asset is being actively marketed at a price that is reasonable. The management is already doing all the process to make the sale possible. Say, for example, marketing the asset at different places, making the advertisement for its sales, etc. So if these three conditions are going to be met, then we can say that the sale of the asset is highly probable. The third condition is the sale is expected to be completed within 1 year from the date of classification as held for sale. If that is not going to be met, then by IFRS 5, we are required to reinstate the asset as a normal asset in our books of accounts. If we are not going to make a sale within 1 year of its classification, then we have to reinstate it as a normal asset as per IFRS 5. However, this is not written in your. The sale is expected to be completed within 1 year from the date of the classification. Now, in the examination, they will be testing you upon this criteria by telling you that whether the sale is probable within 1 year of the classification or not. If the sale is not probable within 1 year of the classification, then you are not supposed to consider it as the asset held for sale. And the last condition is it is unlikely that significant changes to the plan will be made or that the plan will be withdrawn. So as you can see that these conditions are more or less the same which you have read in IS 37 provisions as well. In order to recognize provision also we have certain conditions. So these are more or less the same ones. So let's revise them quickly once again. What is the first condition? The asset must be available for the immediate sale. The second one is the sale is highly probable. The third one is the sale is expected within 1 year of the classification. And the fourth one is that there are no probable changes to be made in the intentions of the management to make the sale of the asset. So if these four conditions are going to be met, then you are required by IFRS 5 to present the asset separately on the face of the balance sheet as an asset held for sale. If any of these conditions is not being met, then you are not required or permitted by IFRS 5 to write the asset separately on the face of the balance sheet. Now, once the classification is being done, you are clear that the asset must have to be classified as held for sale and has to be presented separately on the face of the balance sheet. Then comes the debate that how much value we have to give to that asset which is held for sale. As we have discussed earlier, that the value which you are going to put in front of the assets held for sale is lesser of carrying value and NRV. And NRV is fair value less cost to sell. Whichever is smaller, you have to recognize your asset held for sale on that value in your SOF. Now, if say for example, the carrying amount is more, say for example, because you are comparing both the values, carrying value and NRV. If your carrying amount is more than NRV, what are you going to do? If carrying value is more than NRV.
We take NRV.
We will take?
NRV.
Yes, you are going to take NRV. Then one more thing you have to do, that is as per IS 36. Impairment. If the carrying amount is more than NRV, then there is an impairment as well. And that impairment loss must also have to be recognized in SOP. So this is not written over here, but this will be tested in the examination. Okay? Because in your book, they are assuming that you are having a previously gained knowledge as well. So keep this thing in your mind that if your carrying amount is more than NRV, obviously there is an impairment. And that impairment loss has to be recognized in SOP. So let's see what this says about, say about measurement of non-current assets held for sale. Non-current assets that qualify as held for sale should be measured at lower of their carrying amount and fair value less cost to sell. Held for sale non-current assets should be presented separately on the face of SOFP under current assets and not depreciated. So one more condition is there. Once the asset is being classified as held for sale, it will no longer be depreciated. Once it is being classified as held for sale, it will not be depreciated anymore. So they say where the assets held under the revaluation model are reclassified as held for sale, these assets should be revalued using the method of IS 16 property, plant and equipment or IS 40 investment property as appropriate prior to the reclassification. So under IS 40 and under IS 16, we can use revaluation model or the fair value model. Under IS 16, the model which is being used normally is revaluation model, whereas in IS 40, we can use fair value model. So they are telling us that if any of the model for IS 14 and IS 16 in regards to revaluation and fair value model is being used, then first we have to reclassify as per, we have to record the revaluation gain as per these standards, and then we are going to reclassify our asset as the held for sale. So first we are going to recognize any of the revaluation gain if it's present, then we are going to reclassify it as held for sale. And under IS 16, if there is a revaluation gain, it goes to statement of other comprehensive income. What is the accounting entry? Non-current asset cost, account debit, credit, revaluation surplus. If there is a revaluation gain under IS 40, it goes to SOP. Very good. And the accounting entry is going to remain the same. So this you have to keep in mind. Anyhow, let's move on. Here is understanding number 1. The requirement of the question is at what amount should the machine be stated in Michel's company statement of financial position at 31st December 2003. So they are clearly asking you the amount which has to be presented on the face of the balance sheet in regards to a machine at 31st December 2003. If the year ending date is 31st December 2003, your starting date has been 1st January 2003. Let's read a question. On 1st January 2001, Michel Company bought a stamping machine for $20,000. So on 1st January, the machine has been purchased. 1st January 2001, a machine has been purchased at a cost of $20,000. It has an expected useful life of 10 years and a nil residual value. Expected useful life has been, we can extract the information, students. Expected useful life is 10 years and residual value is nil. They are telling us this information because we may have to apply the formula for calculating depreciation. So in the straight line method, which two formulas can be used in order to calculate depreciation? The first one is cost minus residual value divided by estimated useful life of an asset. And the other one is depreciation charge multiplied by the cost of an asset. Okay. So on 30th September 2003, on 30th September, before to the year ending date, on 30th September 2003, Mitchell Company decides to sell the machine and starts action to locate a buyer. So now the condition regarding the asset held for sale is being fulfilled. That they have decided to sell the machine and starts action to locate a buyer. The machine are in short supply. So Mitchell Company is confident that the machine will be sold fairly quickly. Its market value at 30th September 2003 is 13,500. And it will cost 500 to dismantle the machine and make it available to the purchaser. The machine has not been sold at the year end. So we have to classify it as held for sale. Now, let's extract the other information as well. The plan to make the sale has come into existence on 30th September 2003. We have to classify it as asset held for sale. So from 30th September 2003, we have to recognize this asset under IFRS 5, is it? And at the same date, they have told us that the market value of the asset is how much? 13,500, whereas the cost to dismantle is 500. So we do know that the asset is now fulfilling the condition to be mentioned as held for sale. We are going to write this asset in our SOFP under current asset. Under our SOFP, our current assets, we are going to write it as asset held for sale. And what amount we have to write it in front of this line item? Lesser of carrying amount and NI. So lesser of carrying value and fair value less cost to sell. What is the fair value at 30th September 2003? At the time when the classification as held for sale is being made. Fair value is market value. So it has been 13,500. The cost to make the sale has been 500. This is the cost of dismantling. Once the asset is going to be removed, only then it can be sold as. So this is the cost to sell. So this value is how much? 13,000. One value has been extracted. The other has to be calculated. That is carrying value. What is carrying value? It is cost minus accumulated depreciation. The cost of the asset has been 20,000. We have to calculate accumulated depreciation. The asset has been purchased on 1st January 2001 and it is being reclassified as held for sale on 30th September 2003. So around 2 years and 9 months, we have to take depreciation as well. So yearly depreciation we are going to take, and then we are going to take a sum of that, it will become accumulated depreciation. So depreciation we can calculate over here. At 31st December 2001 for the first year, it will be cost minus residual value. Residual value is 0. Estimated useful life is 10 years. So for the first year, how much depreciation? 20,000 divided by 10. Yes, students? 2,000. Then we are going to take for 31st December 2002. It's a straight line depreciation. Depreciation charge is going to remain the same. So 2000 for the second year as well. Now for the third year, we are not going to take the full year depreciation because on 30th September 2003, the asset has been classified as held for sale. So after its reclassification as held for sale, it is no longer depreciated. So on 30th September 2003, how much depreciation charge will be there? 2000 multiplied by January, February, March, April, May, June, July, August, September. So 9 months are there. 9 divided by 12. How much it is? 15,000? No, 2,000 multiplied by 9 divided by 12. 1,500. So it's 1,500. So accumulated depreciation will be 2,000 plus 2,000 plus 1,500. Okay, so 4,000, 5,000 and 5,500. This is accumulated depreciation. So how much it is going to be? 14,500. These two values have to be compared. Which one is lesser? 13,000. We are going to write this value in SO. 13,000. Is it? Now, as you can see, that carrying value is more than our fair value less cost. So there is an impairment as well. So in your SOPL, you are going to write impairment also. How much impairment will be there? 1,500. Is it? $1,500 impairment is also going to be written in our SOP. See this question once again, students. What we have done, first we have seen that the conditions of classifying an asset held for sale is being met. Immediately at the time of reclassification, we are going to write it under the current assets in our SOFP as mentioning it as asset held for sale. Now we have to see that how much value we have to put against it. In order to measure the value, we have to compare two values, carrying value and fair value less cost to sell. Fair value less cost to sell, the information has been given straight away. So we have calculated it in the straight manner. Fair value is the market value. Fair value is normally the market value. So the market value has been given as 13,500 and the cost to sell has been given as 500. So we had extracted the fair value less cost to sell as 13,000. Then we have to compare it with the carrying value. As we do know, carrying value is cost minus accumulated depreciation. Cost has been given to us in the top line, 20,000 has been the cost. We have to calculate the accumulated depreciation. So for 2 years, 9 months, we have calculated the depreciation, taken a sum of those depreciation and written over here in order to calculate the carrying value. After calculating carrying value, we have compared two values and we found that fair value less cost to sell has been lesser than the carrying value. So on the lesser amount, we have recognized this asset held for sale at 13,000. Since our carrying value has been more than, carrying value is also the book value. It is also known as book value. Since in our books, the value has been more, that is why we have to impair it now. In the market, its price is lesser now. So we are going to calculate the impairment charge since our carrying value has been more than the NR. So 1,500 difference has been there. We are going to carry it in our SOPL as impairment under IAS 36. Ashley, are you cleared?
Yes, miss.
Okay, great. Is everyone clear? Any confusion? May I erase it now? Now, students, we have ended the debate in regards to the assets held for sale. We are going to discuss the next part, that is the classification and measurement of discontinued operations. What are discontinued operations? Let's have a look. A discontinued operation is a component of an entity that has either been disposed of or is classified as held for sale. So the component or the separate line of a business, separate line of the operation of a business which is already being sold, which is already being disposed of, or the management is having an intention to sell it, will be classified as a discontinued operation if the following conditions are being met. First condition is represents a separate major line of business or geographical area of operations. That's what I have told you, that if it's a separate branch, if it's a separate line of operation, we are going to classify it, we can classify it as a discontinued operation. Is a part of the single coordinated plan to dispose of the major line of a business or geographical area of the operations. Management is having an intention to close or dispose of the separate line of the operations, and is a subsidiary acquired exclusively with a view to resale. Sometimes during the life of the business, some subsidiaries are being purchased. Subsidiary is something, is an entity in which the organization is having more than 50% shares. So if it's a subsidiary which has been purchased with the viewpoint of selling, can also be classified as a discontinued operation if at the time of the purchase, the intention of the management has been to sell that subsidiary. So if any of these three conditions are there, we can call a certain operation as our discontinued operation. Now, by showing the performance of the discontinued operation separately, users can see the performance of the remaining operations, enabling them to predict future performance more accurately. So once we are determining that the discontinued operation is present, then we are required by IFRS 5 to mention it, to present its profit or loss separately on the face of the SOPL, because the users of the financial statements can come to know that what are the profits or the losses gained by the continued operations and what are the profits or the losses separately gained by the discontinued operations. So for them to distinguish among those, both of these, we are required by IFRS 5 to separately present the information. So they say an entity must disclose a single amount on the face of SOPL or loss comprising the total of the post-tax profit or loss of discontinued operations and the post-tax gain or loss recognized on the measurement to fair value less cost to sell on the disposal of the assets constituting a discontinued operation. So simply what we are required to do, once the particular operation is being discontinued, we have to present its profit or loss, post-tax gain profit or loss separately on the face of the SOP. But it will be only as a one-line item. Its detail will be shown in the notes to the financial statements. So that's what they are telling us, that an entity must disclose a single amount on the face of the SOPL comprising the total of post-tax profit or loss of discontinued operations and the post-tax gain or loss recognized on the measurement to fair value less cost to sell on the disposal of the assets constituting the discontinued operations. Once the discontinued operation has been sold, two conditions can be there. Once the asset is already being sold, or the asset is just under the intention of the management to be sold, that discontinued operation. If it's being disposed of and any gain is being arising on its sale, that gain also have to be presented on the face of the SOPL separately. It will be added to the post-tax profit or loss of the discontinued operations. And if it's a loss, we are going to deduct it out of the total profit. Now, an analysis of this single amount must be presented either in the notes or on the face of the statement of profit or loss. So by IFRS, we are allowed to present the details on the face of the SOPL as well, but preferably when you will be becoming the auditor or the accountants as well, you will be told by your seniors that you have to present them separately in the notes to the financial statements. So anyhow, they are telling that analysis of the single amount must be presented either in the notes or on the face of the SOPL. The analysis must disclose the revenue, expenses, and pre-tax profit or loss of discontinued operations, the related income tax expense, the gain or loss recognized on the measurement to fair value, less cost to sell, or on disposal of the assets constituting the discontinued operations. This is how the pro forma for the presentation of the discontinued operations is going to look like. As you can see, the first portion, this is the profit from the period for continuing operations. This is going to be calculated in an ordinary revenue minus cost of sales, gross profit, distribution and administration expenses, profit from operations you are going to get. You are going to deduct finance costs. You are going to get profit before tax. From profit before tax, you have to deduct current year estimated tax. You will be getting profit for the period from continuing operations. And then as a one line item, you are going to show the profit or loss for the period from discontinued operations. And the details of this will either be shown in the notes to the financial statements, or they can be shown as all of it in the face of the SOPL as well. So you are going to get the total profit for the period, and the users of the financial statements now can get an idea that how much profit is being attained out of the profit out of the continued operations, and how much loss or gain has been attained out of the discontinued operations. They say the analysis of the single amount as described above would be given in the notes. Alternatively, the analysis could be given on the SOPL with separate columns for continuing operations, discontinued operations, and the total amounts as we have shown. Okay, now students, here is understanding number 2 in regards to that particular thing which we have discussed. The requirement, as you can see, the requirement is to draft the statement of profit or loss for the year ended 31st March 2006. You simply have to draft the SOPL for the year ended 31st March 2006. Saint Valentine produced cards and sold roses. However, halfway through the year ended 31st March 2006, halfway to 31st March 2006 means that in between this year. If the year ending date is 31st March 2006, the year starting date has been which one? 1st April 2005. Is it? Halfway in this year means that after 6 months. So April, May, June, July, August, September. We are talking about September 2005. Okay. So however, halfway through the year ended 31st March 2006, the roses business was closed and the assets sold off, incurring losses on the disposal of non-current assets of 76,000 and redundancy costs of 37,000. The directors reorganized the continuing business at a cost of 98,000. Trading reserves of cards and roses is being given, and then they say other trading information to be allocated to continuing operations is as follows. So this information is again for the continuing operations, finance costs, and tax. Can you start doing this question, students? You are simply required to prepare the SOPL for 31st March 2006. What will be your format? Revenue minus cost of sales. You will be getting gross profit, then minus distribution expenses, minus administration expenses. What you are going to get after that? Profit from operations, which is also known as, what is the other name for profit from operations? Profit before interest and tax. Then you do deduct finance cost. You are going to get profit before tax. Then you are going to deduct tax expense. You are going to get net profit for the year from continuing operations. Then you are going to see that whether you are earning the profit or loss from the discontinued operations. And that is also going to be added or deducted. Profit or loss from discontinued operations. The detail of this can be written in the notes. Separately, you are going to calculate. And you will be getting the value of total profit for the year. So this is the pro forma. Now put the values. Which one is the continuing operation? Cards is the continuing operation and roses is discontinued operation. So here on the face of the SOPL, the details of cards is going to be shown. Yes, how much profit from continuing operations is there? Asif, did you get it?
102.
102. Students, please see that the directors reorganized the continuing business at a cost of 98,000. This also have to be put over there. This is regarding continuing business. They are telling us the directors reorganized the continuing business at a cost of 98,000. Yes, you are going to subtract it as well. This is the other expense. Yes, dear? We have to separate 102. Yes, from 102 you have to. Not from the final one. So what you are going to do, here you are going to write reorganization costs. Okay? Then you are going to get basically profit before interest and tax. So revenue, as you can see, it's 650 for cards. Then cost of sales is 320. Distribution expenses are 60. Administration expenses are 120. Then you have reorganization cost of 98,000. Then tax expense, finance costs are 17. Tax expense is 31,000. You are going to get net profit from the continued operations. Now you have to calculate profit or loss from the discontinued operations as well. But you can show the information in the notes. So you will be making the notes to the financial statements. Notes to the financial statements. You are going to show about profit or loss from discontinued operations. In the same manner, you are going to calculate these as well. Revenue, how much revenue has been there? 320 minus cost of sales. Cost of sales of 150,000. You will be getting gross profit. Then we have distribution expenses. Distribution expenses of 90. Then we have administration expenses of 110. You will be getting profit before interest and tax. But before to that, we can see that they are telling us in the second line, the Rose business was closed and the assets sold off, incurring losses on the disposal of non-current assets of 76,000 and redundancy cost of 37,000. So for Rose's business, we have these two extra costs also. These are the losses on disposal, loss on disposal of non-current assets, and redundancy costs. So these are 76,000 and 37,000 respectively. Then we have profit before interest and tax or profit from operations. There is no interest and tax expense for Rose's business, is it? So this profit before interest and tax will be our total net profit for them. How much it is? $320 minus 150 minus 90 minus 110 minus 76 minus 37. So it's a loss. It's a loss on disposal. Loss on the discontinued operations of 143. Is it? It's 143 loss from the discontinued operations. So this has been for profit, and this is loss of 143. It means the net is 139 loss. There is a total loss for the period that is 139. Yes, any confusion? Tell me if you are not understanding. Thumbs up, please. Is it? The second part of the question is that explain how IFRS 5 discontinued operations presentation can make the information more useful to the users of the financial statements. So since we are separating the profit or loss out of the discontinued operations separately on the face of the SOPL, then the users of the financial statements can distinguish easily that what are the profits or the losses generated from the continuing operations and what are those from the discontinued operations. So they can rely, from this condition, they can rely on the business, since from the continuing operations, it's a profit. Only from the discontinued operations, they may have come to the notice that the discontinued operation has been making a loss. And that is the basic reason for its discontinuation. Okay. So because we can see that 143,000 loss has been made out of the discontinued operations. So the users can get this information when we are separately mentioning, presenting the information on the face of the SOP. Anyhow, these type of the questions, this type of the question cannot come in the exam. Anyhow, in your examination, theoretical questions can come. You know, now ACCA is changing its policy all over. Previous days, in the last week, we had exams of ACCA, you know, in the first week of March. So in the professional papers, we have seen, not in the skills or the applied skills module, but in the professional papers, even in the numerical exams, more than 75% theory has been asked. Okay, so we can expect that in the next attempt in June as well, they will be asking you more theory. So they do not want you to become number crunchers only. Okay, so analysis is must. And I hope that all of you do know that your exams will be on computer. So try to build on your practice by sitting in the computer. Students, now can we move on? Here is the last understanding for this chapter, and we have finished this. This one is the detailed one. Let's have a look at this. Test your understanding number 4, number 1. According to IFRS 5 non-current assets held for sale and discontinued operations, which two of the following relate to the criteria for an asset held for sale? A, the item must be a major line of the operations or geographical area. Is this the criteria for the assets held for sale? Who says yes? Raise your hands. Who says no? Raise your hands. What about you, Hizar and Hamza? It's either yes or no. So this is not the criteria for the discontinued for the assets held for sale. This is the criteria for discontinued operations. Okay. So the item must be a major line of operation or geographical area. This is for discontinued operations, not for assets held for sale. So this is not our option. The second one, the asset must be available for immediate sale. Is this the criteria for assets held for sale? Yes, very good. The first right option is B. Okay, the sale is expected to be completed within the next 3 months. No. It is the sale must be expected to be completed within 1 year of the classification. So this is again the last one, a reasonable price has been set. Yes. So B and D are the right answers. Question number 2. According to IFRS 5 non-current assets held for sale and discontinued operations, which of the following amounts in respect of the discontinued operations must be shown on the face of the SOPL? Okay, revenue in regards to the discontinued operations, shall we show the revenue on the face of the SOPL? Now look over, I told you that in regards to the discontinued operations, it's preferable that you are showing the profit or the loss as one line item. But in your book, they told you that it's you are going to have an option that whether you can show all the detail on the face of the SOPL or separate. But over here, they are going contrary to that. So please keep in mind that you must be showing the profit or loss from the discontinued operations as a one-line item on the face of SOP. Details must be shown in the notes. So according to this, the question is, according to IFRS 5, non-current assets held for sale and discontinued operations, which of the following amounts in respect of discontinued operations must be shown on the face of the SOP? So revenue? No. Gross profit? No. Operating profit after tax? Yes. One line item, profit or loss from the continuing operations. So profit after tax, yes. Operating profit? No. Operating profit is profit before interest and tax. So after this, we do have certain more calculations. That is why operating profit is also not going to be shown. So only profit after tax will be shown on the face of the SOPL in regards to the discontinued operations. So which option is the right one? Option B. Option B is the right one. 3. Clear, everyone? Okay, now question 3. According to IFRS 5, non-current assets held for sale and discontinued operations, how should non-current assets held for sale be valued? Lower of the carrying amount or the fair value? Is it? No. B. Lower of carrying amount or the fair value less cost of disposal? When we have to measure our non-current assets held for sale, at which value they are going to be shown? Lesser of carrying value and fair value less cost to sale. So option B is the right one. Lower of carrying amount or the fair value less cost of disposal. C. Higher of the carrying amount or the fair value. It's wrong. D. Higher of the carrying amount or the fair value less cost of disposal. Wrong. Option B is the right one. It's lower of carrying amount and fair value less cost to sell. Question 4. What should the depreciation expense for the year be? Halfway through the year, an asset is identified as an asset held for sale after meeting the criteria according to IFRS 5, non-current assets held for sale and discontinued operations. At the start of the year, the carrying amount of the asset was 150,000, original cost 200,000 2 years ago. The asset is being depreciated on the straight line basis. Very simple question. Can you tell me what is the depreciation expense for the year? Under straight line method, the depreciation is being calculated. They are telling us that halfway of the year, the asset has been classified as held for sale. This is the first important information. Then they are telling us that at the start of the year, the carrying amount was 150,000, whereas the original cost was 200,000 2 years ago. It means that total of 50,000 depreciation has already been taken. But it was for 2 years. It means that 25,000 yearly depreciation expenses there. If for 2 years it's 50,000, for 1 year it's 25,000. Since it's a straight line basis. So 25,000 depreciation charge is there. Are we going to take it in total? 25,000 depreciation charge? How much we are going to take?
6 months.
Very good, excellent. Because once the asset is being reclassified as held for sale, it will no longer be depreciated. So full year depreciation charge is 25,000. Half year depreciation charge will be 12,500. So we are going to take 12,500 depreciation charge. We can write the calculation over here as well. Carrying amount. At the start of the year was 150,000. Depreciation charge for 2 years is 50,000, is it? So depreciation charge for 1 year would be 25,000, and for current year, depreciation charge for current year would be half year depreciation. $25,000 divided by 2, that is 12,500. So the point which has been tested in this question is that once the assets are being reclassified as held for sale, they are no longer depreciated. So that is why we have to take half-year depreciation. Shall we move on? Okay, now question number 5. What should the asset appear? Where should the asset appear on the SOFP? At the reporting date, an asset is identified as an asset held for sale after meeting the criteria according to IFRS 5. Where should the asset appear on the SOFP? Option A, part of property, plant and equipment under non-current assets. Yes, students. Part of the property, plant and equipment under non-current assets? No. We are going to show it separately. Option B, it is not shown on the SOFP. Asset held for sale are not going to be shown as the part of SOFP. Why blank faces? Assets held for sale have to be shown separately on the face of SOFP under the head of current assets. They are going to be sold in a current year. Current assets. What are current assets? Assets which are primarily purchased for the purpose of resale. What is inventory under IS2? It's a current asset because it is being purchased for the purpose of resale. Is it? So assets which are classified as held for sale have to be shown separately on the face of SOFP under the head of current assets. Okay. So option A is the wrong one. Part of the property, plant and equipment under non-current assets. No. It is not shown on the SOFP. No, wrong. It is shown on the SOFP. Separately below non-current assets? No, it is no longer our non-current asset. Separately below current assets? Yes. So option D is the right. Okay. In accordance with IFRS 5, non-current assets held for sale and discontinued operations, what amount should be recognized on the financial statements for the year to 31st December 2009? What amounts should be recognized in the financial statements? It means that in SOPL and in SOFP both. For the year to 31st December 2009, your starting date has been 1st January 2009. Read this question, students, and do it by yourself. This one is the detailed question. First do it by yourself and then we are going to see. Yes, students. Which option is the right one? Yes, Hamza. Asif. Ali. Is it? Anyone? C? No. Impairment is there, revaluation gain is there, but not 155,000. They say CAT has a year end of 31st December. On 1st January 2009, it classified 1st January 2009, immediately at the start of the year, it classified one of its freehold properties as held for sale. It means that they are no longer depreciated. At that date, the property had the carrying amount of 667,000. At the start of the year, the carrying amount at the date of classification, the carrying amount of the freehold properties was 667,000. Carrying value is 667,000 and had been accounted for according to the revaluation model. Now the thing is that it has been classified under revaluation model. So when the assets are being classified in the revaluation model at the time of reclassification as held for sale, first we are going to calculate any revaluation gain and we are going to record it in an ordinary way. And then we are going to calculate the fair value less cost to sell and carrying amount. And we are going to compare both of these values, whichever is lesser. At that amount, we are going to write it in SOF or held for sale assets. So they say and had been accounted for according to the revaluation model. Its fair value was estimated at 825,000 and cost to sell at 3,000. Fair value less cost to sell has been, fair value is 825,000 and cost to sell is 3,000. So it means that it is 822,000. Whichever is lesser at that amount, we are going to write it. But the point over here to be mentioned is that because revaluation model has been used, first we have to calculate revaluation gain. If there is any revaluation gain or impairment has to be calculated. How do we calculate revaluation gain? We do compare carrying value and fair value. So how are we going to compare it? How much revaluation gain is there? How much revaluation gain is there? Calculate and tell me. 158,000. Okay, how do we calculate it? Fair value minus carrying value. So 825,000 minus 667,000. Is it the right way, students? Is everyone getting the same revaluation gain? Sorry? How? Which one? If you are deducting 667,000 out of 825,000, how much are you getting? Okay. Do that once again, Ravi, and tell me what answer you are getting. So you are going to compare both of these values. Whatever gain you are going to get, you have to report it. If it's 155 or it's 158, you have to write. How much it is, Ali, now? 158. So in order to calculate the revaluation gain, you do compare fair value and carrying value. Fair value has been 825,000, whereas carrying value is 667,000. So revaluation gain is 158,000. 158,000 revaluation gain has to be recorded in our revaluation surplus. Got it? And then on the other hand, it will be recorded in our statement of other comprehensive income, not in SOP. Is it? So revaluation gain of 158,000 will be recorded in revaluation surplus under the head of equity and in the statement of changes in equity. Now, come to the further debate. The point over here now which we need to note that From now onwards, at the date of the reclassification, the asset has been reposted at which amount? 825,000. Is it? Now, what is the carrying value from the date of the classification? 825,000. Now, instead of comparing this carrying value has to be compared with the fair value less cost to sell. Getting my point? Normally, what do you do when there is no revaluation model being used? In an ordinary way, you just compare the carrying value with the fair value less cost to sell. But where the revaluation model has been used, and over here, exceptionally, it has been used in the start of the year, and the asset has been reclassified as at the start of the year. So at the start of the year, now the asset will be shown at 825,000. And this value has to be compared with the fair value less cost to sell. Now the fair value less cost to sell is 822,000. Asset held for sale will be mentioned in our balance sheet at 822,000. Asset held for sale. Clear up till here, but they have not required us. In any of the option, classification in SOFP is not required. Now, one more thing. Carrying value is more than fair value less cost to sell. So there is an impairment also. How much impairment is there? 3,000. 3,000 impairment is there, which has to be written in our SOPL. So which option is the right one? Option D is the right one. In our SOPL, impairment loss of 3,000 is going to be recognized, and revaluation gain has to be recognized at 158,000. In SOPL, no gain, no loss is going to be nil. Cleared? If in the first option, in the second option, they have written profit or loss gain as well. If the asset is going to be sold at a price lesser than the carrying value, then there will be a loss. Okay. But here no information has been provided in regards to that, so there is no profit. Option D is the right. Yes, Ali, are you clear now? Shall we move on? Question number 7, students. For each issue, identify the correct accounting treatment in Madeira's financial statements. Number 1, a loss-making division which Madeira have agreed to close next year. Which one it is? Asset held for sale or discontinued operation? Which one it is? Discontinued operation? No. Asset held for sale? Neither. Very good. Because a loss-making division which Madeira have agreed to close next year. If it's to be closed within a year, at the end of the year, then it is a discontinued operation. It's neither. The factory of Madeira, which is being marketed at a reasonable price at a year end, which one it is? Asset held for sale? How do you think that it's asset held for sale? A factory of Madeira which is being marketed at a reasonable price at the year end. How do you think that it's asset held for sale? Because it is being marketed at a reasonable price at the year end. So that is asset held for sale. This is one of the conditions being fulfilled for assets held for sale. That is why it's asset held for sale. Then Madeira's specialized plant, which will be advertised for sale once it has been dismantled. Once it has been dismantled. Is it asset held for sale? Is it discontinued operation? Madeira's specialized plant. It either can be asset held for sale or neither. It is not discontinued operation anyhow. Discontinued operation is a business. Is a separate line of operation, whole business we can say. Asset is just an item, okay? So it's a plant, so it can either be asset held for sale or none of asset held for sale and discontinued operations. So Madeira specialized plant which will be advertised for sale when it has been dismantled. Which one it is? Neither. Because it is not yet dismantled, it is not available for an immediate sale. So it is not asset held for sale, it is not discontinued operation. Clear? Now students, we in this chapter, we have 4 standards. In chapter number 8, we have 4 small standards. Okay. One of the accounting standard out of this chapter we are going to discuss. Another 3 we are going to discuss somewhere, in future. Okay, we are going to discuss. So in this chapter right now, we are going to discuss about IS 8. Okay. After IS 8, we have IFRS 13, IS 2, which we are going to discuss later. And today, one important standard which we have to start is IFRS 9 and 13, which is going to be discussed in this chapter. Okay, we are just going to start it. We are not going to finish it right. Before the further discussion, now we are going to have a break. After break, we will resume. Okay, Ashnika, see you after the break then.
Okay, miss.
Ashnika, are you here?
Yes, miss, I'm here.
Oh, great. So we are resuming class. Students, now we are going to start our chapter number 8. You do know that in total we have around 22 chapters in your book. We are starting now chapter number 8. Before to this chapter, we have 2 small theoretical chapters. Those are regarding conceptual framework of accounting and finance. That conceptual framework is regarding the definition of assets, liabilities, income, expenses, and equity, and those principles and conventions which we have studied in F3. Do you remember? Prudence concept, then comparability is there, then we have few conventions as well. So I just request you to go through those 2 chapters by yourself. Okay, just a theory is there and pre-built knowledge is there. So just go through it by your own. Now we are going to start chapter number 8. In this chapter, we have 4 small standards from examination point of view. 2 standards out of these 4 are important and can be tested for 3 or 4 marks. The other 2 are not that important. I will be telling you which one are those. Okay. So today from this chapter, we are going to discuss only 1 standard. The rest 3 we are going to discuss anytime in the future. These 4 standards are which are going to be discussed in this chapter are IS 8. Then we have IFRS 13, fair value measurement. Then we have IS 2, inventories, and we have IS 41, agricultures. Okay, agriculture. Now, inventory and IS 8, accounting policies, is important, which can be tested in the examination. IFRS 13, fair value measurement, and IS 41 is not that important. It can come in the examination, but not more than 3 or 4 marks. The other 2 are going to be tested in the examination. So we are going to start our discussion by having a look at IS 8, that is accounting policies, changes in accounting estimates and errors. A very small standard it is. And when the question on this particular standard does come, it's a theoretical one. Numerical question does not come normally from this standard. Only theory is going to be asked. In this particular standard, we have definitions for 3 things: accounting policies, accounting estimates, and errors. Preferably, we do call these errors as prior period errors, those errors which have been committed in the previous years in the financial statements. So in this standard, IS 8 is providing us the definitions of these 3 things. What are accounting policies? What are accounting estimates? And what are prior period errors? And how are we going to report them in our books of accounts? Students, there are 3 basic things which are being told to us in every standard. Those 3 things are recognition. How do we recognize the items in our books of accounts? In every standard, we are reading this, we are learning this. Then we do learn that how do we present those items in our books of accounts. And number 3 is measurement. What is the value which we do right for different items in our books of accounts? Normally, every international accounting standard and every international financial reporting standard tells us about these 3 things. The recognition criteria. What is the criteria which needs to be fulfilled in order to write any item as an asset, liability, equity, income, or expenses? How do we present them? Where in the books of accounts we need to present those items? And measurement, which value are we required to report in regards to those items which are under consideration? Now, this standard is related to these 3 terms: recognition, presentation, and measurement. Where is it related? I will be telling you. So first, while starting this standard, we are going to have a look at these 3 terms: accounting policies, estimates, and errors. They say IS8 governs the following topics: selection of accounting policies, changes in accounting policies, changes in accounting estimates, and correction of the prior period errors. So this standard is basically covering accounting policies, introduction. If there is a change in the accounting policies, what we are going to do. If there is a change in accounting estimate, what we are required to do. And if there has been a prior period error which has been caught in the current year, what we are going to do. We are going to look at the definitions of accounting estimate, accounting policies, and prior period errors. But please keep this thing in your mind that if there is a change in accounting policy, if the accounting policy has been changed, as per IS8, we have to give its effect retrospectively. What is an accounting policy? We are going to learn. But if there is a change in accounting policy during the life of a business, we are going to give its effect retrospectively. Retrospectively means that prior periods are also going to be adjusted and future is also going to be adjusted accordingly. So this is a retrospective effect. If there is a change in accounting estimate, then we are only going to show a change prospectively. Only the future periods are going to be changed as per the new accounting estimate, not the previous years. If there is a prior period error being caught, then opening balances are also going to be changed. And obviously, in this way, we are showing a change in all the previous years. So opening balances where the error has been caught are going to be changed. Got it? Because for prior period errors, we cannot change future. The future is obviously going to be done in an accurate way. So the prior period errors are those which have been committed previously. So accounting policies, retrospective effect is going to be there. Accounting estimates, only prospective in the future. And in errors, obviously opening balances are going to be changed. Now, one by one, we are going to have a look at the definitions. What is an accounting policy? Generally speaking, students normally have a confusion in regards to differentiation among accounting policies and accounting estimates. Students, accounting policies are those which govern you in regards to the recognition and presentation of the items in your books of accounts. What to recognize and where to present it. The things, the lines in the standards which are governing us about the recognition criteria and the presentation of the line items in books of accounts is regarded in accounting policies. The measurement basis, how are we going to measure certain item, estimates does tell us. Say for example, whether a certain item in front of us is an asset, a liability, or equity. It is an accounting policy. Our policy is to recognize our shares as our equity. This is an accounting policy. It is governing us that which particular conditions need to be fulfilled in order to recognize equity in our SOFP. On the other hand, say for example, if you are applying a depreciation method, reducing balance method of calculating depreciation in order to calculate depreciation expense, that is an estimate. Residual value is an estimate. Useful life is an estimate. Okay, so those things which are helping us to calculate the value of the line item in our books of accounts is accounting estimate, and the conventions behind that, the rules and regulations, the recognition criteria behind to it are accounting policies. So theoretical things are accounting policies, whereas monetary terms are estimates. Okay. Now let's see the definition. Accounting policies are the specific principles, bases, conventions, rules and practices applied by an entity in preparing, presenting financial statements. So all those conventions, all those principles, like I was giving you an example of accruals, prudence, these going concern concepts, these are policies. These are conventions, accounting principles, which are underlying the basic standards of the financial reporting. So accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. IS 8 requires an entity to select and apply appropriate accounting policies complying with IFRS and interpretations to ensure that the financial statements provide information that is relevant to the economic decision-making needs of the users. So this is just a theory. They are telling us that accounting policies have to be applied in such a manner that the users of the financial statements can make accurate economic decisions based upon that. Say, for example, if you are classifying a certain item as your expense, but it's your asset, it means that users of the financial statements will be making wrong economic decisions based upon this presentation. So accounting policies have to be applied in such a manner that the economic decisions, monetary decisions of the users of the financial statements must not be adversely affected. Got it? Then they say, reliable in that the financial statements represent faithfully the financial position, financial performance, and cash flow of the entity. Faithful representation means true and fair view. True means accurate. Fair means unbiased. Accounting policies have to be applied in such a manner that true and fair view of the actual financial position of the company can be seen by the users of the financial statements. Reflect the economic substance of the transactions, other events and conditions, and not merely the legal form. This is a very important point. Do you remember a policy and convention of substance over form? Substance over form is one of the accounting principles. When you are going to read chapter number 6, over there it's written again. Substance over form means that economic substance of the transaction will be having a priority over to the legal form. The basic purpose of the financial accounting, go to lecture number 1. Over there I told you that the definition of financial accounting is that it's an art of recording, classifying, and summarizing financial transactions for the purpose of analysis. And who has to make that analysis? Users of the financial statements. Stakeholders do look at the financial statements to analyze the financial position of a company. Now, as for the comfortability of the users of the financial statements, financial reporting standards tell us that whenever the economic substance of the transaction, underlying economic substance of the transaction is coinciding with its legal form, we are going to give a priority to the economic substance. Normally, we go for the legal form. It doesn't mean that we are going to go against the law. It's not going against the law, but going towards the economic substance for the betterment of the decisions which are going to be taken by the users of the financial system. Say, for example, the legal form of the shares is shares. We have to present them under equity. But there are few kinds of the shares which have to be redeemed, upon which we do say that dividend is mandatory to be paid and their principal amount is also have to be returned. This is not the normal characteristic of the shares. Am I right? But these kind of the shares are not going to be reported under equity. Their name is shares, but we do report them under liability. because it's a characteristic of the liability that the amount of the principal is mandatory to be paid, together with the dividends, continuous return has to be paid as well. For shares, it is not necessary. Dividend is not promised to be paid at the time of issuing them, is it? So this is where economic substance of the transaction is going to coincide with the legal form, and over here we have to give priority over to the economic substance. The economic policies, the basic purpose of applying economic policies is this also, that whenever the economic substance is coinciding with the legal form, we have to give priority to the economic substance. So they say, reflect the economic substance of the transaction, other events and conditions, and not merely the legal form. Are neutral, free from bias. So unbiased presentation has to be done. Unbiased means that maybe the organizational management directors does want to show lesser profit. But obviously accounting policy must be negating this fact. They should be stopping them to do this. This is illegal. And prudent means cautious, that all the foreseeable losses have to be accounted for immediately at the time of knowing them, but not the profits. Okay? Are complete in all material respects. All the material items are must to be reported in the financial statements. It doesn't mean that immaterial items are going to be excluded from the financial statements, but we cannot neglect or negate our material items. They have to be presented in the financial statements. What is the concept of materiality? What are material items? Materiality is an important concept, students, in financial reporting, which means that all those things which are going to influence the economic decisions of the users are material. All those items, all those amounts which can affect the economic decisions of the users are material items. So we cannot neglect the material items. We cannot exclude them from our books of accounts. They are mandatory to be included in the books of accounts, and this is governed to us by accounting policies. Now, the thing is that when we are changing the accounting policy, what is going to be effect in our books of accounts? If there is a change in accounting policy, if there is any change in recognition or the presentation of the line items in our books of accounts, how are we going to deal with that? The simple conclusion in regards to this slide is that we are going to give the effect retrospectively. The previous year financial statements are also going to be changed, and current year financial statements are also going to be changed together with the future as well. Normally in the organizations, we do say that accounting policies should be unchanged. We should not be changing the accounting policies again and again, because every time it is not possible to change to give the retrospective effect. Moreover, the users of the financial statements are going to be disturbed, and the organization will be giving the unfair representation. So we should not be changing the accounting policies frequently, but in case if they are changed, we have to give the effect retrospectively. So they say the general rule is that accounting policies are normally unchanged from period to period to ensure comparability of the financial statements over time. What is comparability? Comparability is again a principle of accounting. It means that we have to make our financial statements in such a manner that they can be compared with the other company's financial statements and our own financial statements in the prior periods as well. Okay, so when you are going to see the actual financial statements of the company, maybe you have analyzed that 2 years financial statements are given on the same page. If it's the financial statement of 2022, you will be seeing the result of 2021 also on the same page. So this is fulfilling the principle of comparability. Okay. So IS 8 requires accounting policies to be changed only if the change is required by the IFRS standard. Like in the days of COVID, so many updations in the standards have come, especially in IFRS 15 revenue. So if there is any accounting policy being changed by IFRS reporting committee by itself, then it has to be updated, obviously. Normally, it is not going to be changed. Or the results in the financial statements providing reliable and more relevant information. Or sometimes your organizations just think that updating the accounting policy will be giving more reliable results to the users of the financial statement. So in that case, if there is any kind of strong reason to change the accounting policies, only then we are required to change the accounting policies, otherwise, no. A change in the accounting policy occurs if there has been a change in recognition, presentation, measurement basis. Recognition, that is an expense, is now recognized rather than an asset. So if something is governing you about the recognition criteria, it is going to be an accounting policy. Presentation, that is depreciation, is now included in the cost of sales rather than administrative expenses. And measurement basis, stating assets at replacement cost rather than historical cost. Students, do not confuse yourself that measurement basis will also be is also going to be constituted as an accounting policy. Measurement base can be constituted as an accounting policy, but how are we measuring it? It's not accounting policy. It is our estimate. Say, for example, stating assets at replacement cost rather than historical cost is accounting policy, but how are we going to calculate it? It's our estimate. Okay, so if there is any change in regards to these things, we can say that accounting policy has been changed. And what is going to be its effect in our books of accounts? Let's have a look at this slide. Accounting for a change in accounting policy. The required accounting treatment is that the change should be applied retrospectively with an adjustment to the opening balance of the retained earnings in the statement of changes in equity. Students, when we are saying that the retrospective effects have to be given regarding accounting policies change, how are we going to show those effects? Retained earnings are going to be changed. Opening retained earnings are going to be changed. What are opening retained earnings? The retained earnings of the last year. What are retained earnings? What is the formula to calculate retained earnings? Opening retained earnings plus profit, or if it's a loss, we have to deduct it, minus any kinds of dividends is equal to closing retained earnings. If there is a capital introduced during the year in sole tradership, then it also has to be added. So simply saying opening retained earnings plus profit of the year minus dividends is closing retained earnings. So if we have to give an effect retrospectively, the previous years also it has to be shown, then the opening retained earnings of the period are going to be changed. By changing opening retained earnings, we ensure that the change is now given retrospectively. The previous year's effect has already been given because it's only the profit which is the final figure which we are getting from the previous years, is it? Which is going to be reflected in the future as well. So by changing the retained earnings, we can ensure that the effect has been given retrospectively. So comparative information should be restated unless it is impracticable to do so. Sometimes we being more efficient in the organization, when our organization is not running on a very large scale, we change the comparable figures as well. Say, for example, revenue, cost of sales, admin expenses, all the figures are going to be changed. But if it is impracticable, it is not possible, then the standard is not requiring us to do so. Only we can change the retained earnings, and changing the comparative figures is not necessary to be done. But if it's practical, we can go for that as well. If the adjustment to the opening retained earnings cannot be reasonably determined, the change should be adjusted prospectively. Now, this is a very sensitive point in the IS 8. And you also, when you are going to become chartered accountants, you will also be taking advantage of these loopholes in the standards. Standard says that you have to give the effect retrospectively. But if it's not possible, prospectively also, you can do that. And what do the financial accountants do? They change the accounting policies to gain unfair advantages. And again, they do say in the notes to the financial statements, because it was impracticable to give the retrospective effects, they do change only the future. It happens, and it is known as window dressing. Window dressing or creative accounting. This is a normal case in the organization which is done, because normally we do say that auditors or the bookkeepers have to work for the shareholders of the organization. But trust me, when you will be becoming the financial accountants as well or the auditors, you will be going for the advantages of the directors of the organization. And directors do normally, obviously, they do try to defraud the shareholders of the organization. So when you are going to protect the rights of the directors of the organization, you have to play with this as well. So this is what the standard says over here, that if the adjustments to the opening retained earnings cannot be reasonably determined, the change should be adjusted prospectively. That is included in the current period statement of profit or loss. So the general requirement is that whenever there is a change in accounting policies, you have to give the effect retrospectively. You have to change the opening retained earnings of the organization. And if it's possible, if it's practical, then you have to change the comparative figures as well. But if it's not possible, you can give the change only prospectively. You can change only the current year figures, and you are going to adopt the same accounting policies in the future as well. Clear? Any confusion up to here? Now, students, we are going to learn about the definition of accounting estimates. All the things, all the, we can say the lessons which are going to govern us about the measurement criteria of the things to be shown in the financial statements will be known as accounting estimates. IS 8 tells us that an accounting estimate is a method adopted by an entity to arrive at estimated amounts for the financial statements. Say, for example, NRV. How NRV is being calculated? There is an accounting estimate. How have you calculated NRV? Which was the fair value being taken? How much cost of sales being taken is going to be your accounting estimate. How you are calculating depreciation? How are you calculating provisions? This is your accounting estimate. An accounting estimate is a method adopted by an entity to arrive at estimated amounts for the financial statements. Most figures in the financial statements require some estimation. The exercise of judgment based on the latest information available at the time. At a later date, estimates may have to be revised as a result of the availability of new information, more experience, or subsequent developments. So estimations are just based upon the judgments. They are very subjective. They are based upon few what we can say estimations or judgments or subjectivity of the financial accountants. And those estimates can be changed also when some new information is added to the scenario. Like we have seen in IS 16 also, when there has been a review of the useful life or the review of the residual value as well, or review of the impairment also. So in that case, obviously the accounting estimates can be changed. If you can recall the concept, when in one question we did that the residual value and the expected useful life of the asset has been changed. So in that case, depreciation in the future now has to be calculated as a prospective effect. Do you remember? At that time, the formula of the depreciation becomes as carrying value minus residual value divided by new expected estimated useful life of the asset. So over there, what we were doing, we were giving the effects in a prospective manner. In the current year and the future years, we are giving the effects. So that is one condition in which the accounting estimate has to be adjusted in the current and the future years. So let's move on. Change in the accounting estimate. The requirements of IS 8 are the effects of a change in accounting estimate should be included in the statement of profit or loss in the period of the change. And if subsequent periods are affected, in those subsequent periods also. The effect of the change should be included in the same income or expense classification as was used for the original estimate. So like in the depreciation, if the reviews are going to be changed, we have to adjust it only in the depreciation. In the relevant income or the expense, it has to be adjusted, not in the other retained earnings, etc. If the effect of the change is material, its nature and amount must be disclosed. Now, if sometimes the change is going to bring only the immaterial effect, that immaterial effect which is not going to change economic decisions of the users, it's very small in nature. But sometimes it's very material, it's a big amount. It's a big amount in comparison to the total profits of the organization. So if it's a material amount, then it has to be disclosed in the notes to the financial statements as well. Disclosure means what we are writing in the notes to the financial statements. Okay. So recognition means that what we are writing in the books of accounts. And disclosing means what we are writing in the notes to the financial statement. So if it's a material item about which the accounting estimate is being changed, it has to be disclosed, it has to be written in the notes to the financial statements as well. Examples of the changes in accounting estimates are changes in the useful lives of the non-current assets. It's an accounting estimate, a residual value of the non-current assets, the method of depreciating non-current assets, warranty provisions based upon more up-to-date information about claims frequency and value. In the examination, they can give you the options out of which you have to select which one is accounting policy and which one is an estimate. So one particular typical type of the question can be like this. Here is a question, students. Which of the following is a change in accounting policy as opposed to the change in estimation technique? How are you going to distinguish upon accounting policy and an accounting estimate? Those things which are going to affect the recognition and presentation criteria will be your accounting policy. Those which are going to affect the measurement is going to be your accounting estimate. So number one, an entity has previously charged interest incurred in connection with the construction of tangible non-current assets to the SOPL following the revision of IAS 23 borrowing costs. And in accordance with the revised requirements of that standard, it now capitalizes this interest. What is it? Accounting policy or estimate? Before it was being recorded as interest incurred in connection with the construction of tangible non-current asset, it was being recorded in SOPL. Now it is being classified under IAS 23 borrowing cost. It is not being capitalized. So what is it? Very good. It's accounting policy. It is changing the presentation. When it was a finance cost, it was presented in SOPL. Now it's in a borrowing cost. It is now capitalized. It's presented in SOFP. So it is a change in accounting policy. Clear? So whichever things are going to change, the recognition and the presentation of the items will be accounting policies. First one is accounting policy. Second one, an entity has previously depreciated vehicles using reducing balance method at 40%. It now uses the straight line method over a period of 5 years. Accounting policy or accounting estimate? Estimate. It is changing the measurement. Before, the asset has been taking a depreciation of 40% reducing balance method. Now it is going to have straight line basis, same level of depreciation. The second one is accounting estimate. Third, an entity has previously shown certain overheads within cost of sales. It now shows those overheads within administrative expenses. Yes. Policy. It is changing the place of the items. Okay, before it has been mentioned under cost of sales, now within administrative expenses. So it is showing the change in the classification, in the presentation. So it's an accounting policy. Fourth one, an entity has previously measured inventory at weighted average cost. It now measures inventory using FIFO. Is it a policy or an estimate? It's a policy. Percentage is not mentioned. The method is mentioned. Okay, measurement basis. An entity has previously measured inventory at weighted average cost. It now measures inventory using FIFO. It is a policy. It is a policy. Look, now the measurement basis. The measurement base is being changed. Before it was weighted average, now it is first in, first out method. If they say that 40% or like in the second point it was there, or 20%, this much amount is going to be taken, then it's an estimate. It's a policy. Whether which method we have to use, it's a policy. Cleared? Now, prior period errors. Prior period errors are omissions from and misstatements in the financial statements for one or more prior periods, arising from the failure to use information that was available when the financial statements for those periods were authorized for issue and could reasonably be expected to have been taken into account in preparing those financial statements. So prior period errors can be happening in any of the cases. Maybe at the time of preparing the financial statements before, you were not aware of some information which has come to your site now. Currently, it has come to your site. Or maybe in the prior period, maybe the directors wanted the financial accountants to make some deliberate false information. And now, because of the auditor's intervention, obviously it has to be caught. And that is why the prior period errors have come to the side of the financial accountants. So in that case, also the prior period errors can be caught and they have to be changed also. So such errors include mathematical mistakes, mistakes in applying accounting policies, oversights, and fraud. Current period errors that are discovered in that period should be corrected before the financial statements are authorized for issue. If your financial statements are not yet authorized for issue, authorization for issue means that directors' initials have been stated on the financial statements. Once the auditors do check the financial statements are authorized for issue. The directors put their initials on the end of the financial statements that we have authorized this. Then after 6 months of the year-ended annual general meeting, they are presented in front of shareholders. So after 3 months of the financial period end, the financial statements are normally authorized for issue. Anyhow, before to the authorization of the financial statements for issue, if any error comes to the side of the accountants, it has to be corrected. Otherwise, if it has been come to the side after the authorization, then obviously retained earnings have to be changed. Now, correction of the prior period errors. Prior period errors are dealt with by restating the opening balance of assets, liabilities, and equity as if the error had never occurred and presenting the necessary adjustment to the opening balance of retained earnings in the statement of changes in equity. So are we going to ensure that the prior period errors are being adjusted? We are going to change the opening retained earnings, restating the comparative figures presented as if the error had never occurred. In the particular point where on the particular phase where the error has been committed, if it is practical to be changed, then we have to change that as well. Disclosing within the accounts a statement of financial position at the beginning of the earliest comparative period. In effect, this means that 3 statements of the financial position will be presented within the set of financial statements at the end of the current year, at the end of the previous year, and at the beginning of the previous year. So obviously, when the retained earnings are going to be changed, we are having 3 types of the statements right now. One is at the end of the current year, at the end of the previous year, and at the beginning of the previous year. These 3 are going to be changed automatically. Now, students, this is all for the standard, nothing more to be discussed. One illustration is being there, that is illustration number 3. Please try that illustration from your books. Other standard in this chapter is IFRS 13, fair value measurement, which I have told that we are not going to discuss it now. IS2 inventories, it's already been discussed in F3, but once again, in a summarized manner, we are going to discuss it here. And one more standard, IS41, is also in this chapter, which by mistake I have not added. Okay, I will add it later. So these 3 standards we are going to learn later. Now, a very important chapter we are going to start, that is chapter 9 in regards to financial assets and financial liabilities. This chapter is covering financial instruments. Financial instrument is something for which the students are normally very afraid of. I do not know what is the reason behind it, but maybe they are not having a concrete concept behind it, or maybe in F7 it's a new chapter, it's a new standard. Somehow the students are afraid of this standard, and not only you. When I used to take the trainings for very aged individuals as well. They are very afraid of financial instruments. Anyhow, it's not a very difficult standard, but some concepts can be a little bit complex for you. Okay, so do not be afraid of this, but try to understand what the standard is trying to tell you. One more reason of the students being afraid of this financial instrument is that 3 standards are dealing with this alone financial instrument. These are IS 32, IFRS 7, and IFRS 9. 3 standards are dealing with the financial instruments. Now, these keep on updating as well. Few updations have also come already, and few updations are coming, they used to come previously as well. So when you will be becoming the accountant, professional accountant, then it's your duty that you have to keep updating your knowledge as well. So within financial instruments, we are going to deal with these 3 standards, IS 32, IFRS 7, and IFRS 9. As you can see, IS 32, it's about financial instruments presentation, about the presentation of the financial instruments. Where do we write the financial instruments in our books of accounts? What is the place of the financial instruments in our books of accounts? IFRS 7 deals with the disclosure requirements of the financial instruments. In regards to the financial instruments, what are we required to write in the notes to the financial statements? And IFRS 9, which is the basic standard, which we are going to discuss more often, is financial instrument measurement. That how are we going to measure our financial instruments, what value we are going to report in our financial instruments is going to be guided to us by IFRS 9. Now, what are financial instruments? Financial instrument can be any financial asset or a financial liability. It can be equity, it can be debt, it can be asset. So what are financial instruments? We are first going to learn the definition of financial asset and a financial liability, and then we are going to extend our discussion. Normally, we do say that a financial instrument is either a financial asset or a financial liability. If it's for one party, it's a financial asset. It's most that for the other party, it's either a financial liability or a equity. So for one party, if it's a financial asset, for other party, it's most that it's either a financial liability or an equity. So this is basic of the financial instrument. So it can either include a financial asset or a financial liability. Today, we are going to cover the discussion regarding financial asset. The discussion of financial asset, we are going to cover. Financial liability, we are going to discuss. Anyhow, what is a financial instrument? A financial instrument is any contract. First thing which you need to consider that a financial instrument is always a contract. The liabilities or the rights which are going to arise under a financial instrument must be based upon the contract between 2 or more parties. Okay, so contractual obligations are going to be arised in the financial instrument. Sometimes there are statutory or the legal liabilities as well. But those are not financial instruments. Those are not going to be making your financial instrument. Students, what is a financial instrument? What is your view about financial instrument? What it can be? Shares are financial instruments. Options, debentures, these are financial instruments. Okay? We are just collectively giving them the name of the financial instrument. If you think about equity, if for you it's an equity, for other party it's an asset, it's their investment. Okay? Anyhow, receivables, payables, these are financial instruments. A financial instrument is any contract that gives rise to the financial asset of one entity and a financial liability or equity instrument of another entity. So if it's for one party, it's an asset. For other party, it's most that it's either a liability or an equity. Even loan debentures are the financial instruments. If you are taking a loan, for you it's a liability. For the other party, it's an asset. If say, for example, you are taking a loan from the bank, for a bank you are receivable. For a bank you are a receivable. So it's a financial instrument for bank. And for you people, it's a liability. So for bank, it's a financial asset, is it? So in the banking sector, financial instruments is normally being used. What are financial assets? A financial asset is any asset that is a cash. Cash is also financial instrument. Then a contractual right to receive cash or another financial asset from another entity, that is receivables. A contractual right to exchange financial assets or liabilities with another entity under conditions that are potentially favorable. What is this? They are highlighting swaps and options, derivatives. These three things are not the subject matter of F7. They are not either the subject matter of financial reporting. These are going to be discussed in F9, financial management. Okay. Anyhow, they are telling us that it can be a contractual right to exchange financial assets or liabilities with another entity under conditions that are potentially favorable. So this is excluded from our syllabus. An equity instrument of another entity is also the financial instrument. So examples of the financial assets include trade receivables, options, investments in equity shares. Normally, options can work in this way. Let's say, for example, right now you have purchased the debentures of a company. You have purchased the loan notes of a particular company. And in future, when the company has to return that amount to you for debentures, obviously the company has to return the amount in the future specified date. In the future, you are being given an option that either you can take an amount back from the company or you can convert that amount into the equity shares of the company. So here is an option. So those options are also going to be included in the financial instruments. Anyhow, how does these options just work? It's not the part of our syllabus. What are financial liabilities? Just opposite to the financial assets, we have financial liabilities. A financial liability is any liability that is a contractual obligation. Whatever financial instrument is there, it must be arising out of the contractual obligation. Sometimes in the exam, they will be giving you a situation in which statutory obligation is there. So that would not be a financial instrument. If, say, for example, income tax liability is there, is it a financial instrument? No, because income tax liability is your statutory obligation. Okay. To deliver cash or another financial asset to another entity, that is payables, trade payables. To exchange financial assets or liabilities with another entity under conditions that are potentially unfavorable, these are options. That will or may be settled in the entity's own equity instruments, again, options. Okay. So the examples of the financial liabilities include trade payables, debenture loans, redeemable preference shares. Now, redeemable preference shares are which thing? Are these shares or they are loan? Liability. Are these equity or liabilities? Liabilities, very good. Redeemable preference shares is following the concept of substance over form, which we have discussed. By name, legally they are shares, but their economic substance is that of a liability. So they are also our financial instrument. Anyhow, if there are normal shares as well, ordinary shares also, they are equity and these are financial instruments. Okay, now illustration number 1 is, dear students, identify which of the following are financial instruments. Number A, inventories. Are inventories financial instruments? Does inventories arise out of the contractual obligation? Yes, contractual obligation is there. If we are purchasing an inventory, contract is there. Okay. What do we get when we have inventories? What are we getting? Stock we are getting? Are they going to be considered as a financial instrument in any way? Is it giving you a right, any right to get the cash in the future? Is it giving you any right to get a cash in the future? Can you claim a cash by just having an inventories from some individual? No. Inventories are just your normal assets. They are not financial instruments. You have purchased inventory, they are in your warehouse. Unless you are going to sell them on credit, your receivables will become your financial instrument. Inventories alone are not your financial instruments. They are not cash and they are not giving you any right to the cash, cash claim in the future. So they are not financial instruments. Getting it? Inventory is a contractual obligation can arise when you are purchasing an inventory, but it is not a financial instrument. Then investment in ordinary shares. It's a financial instrument. Prepayments for the goods or services. Prepayments of goods or services. Prepayments of goods or services are your normal assets. These are your current assets. But when you have paid for the goods or services in advance, what you are going to get in the future? You are going to get goods or services. Those goods or services is not an outcome of the financial instrument. The outcome of the financial instrument must be in monetary terms. Getting it? Receivables is a financial instrument because the outcome is in monetary terms. Prepayment for the goods or services, if you have paid in advance for any goods or services, the outcome is not in monetary terms. So it is not a financial instrument. Liability for income taxes. No, as we have discussed, is the statutory obligation. So it is not our financial instrument. A share option. Yes. An entity's obligation to issue its own shares in the future instead of giving back the loan can be a financial instrument. So inventory is not a financial instrument. Investment in ordinary shares is a financial instrument. Prepayment for goods or services, not a financial instrument. Liability for income tax, not a financial instrument. And share option is a financial instrument. Clear, everyone? Any confusion? No? Okay. Now, students, how are we going to recognize our financial liabilities? Okay, in this slides, I have discussed about financial liabilities. Financial assets, we are going to discuss later. Initial recognition of the financial liabilities. Students, when we are going to initially recognize the financial liabilities in our books of accounts, we have to recognize them at fair value. What is a fair value? A net proceed of the cash received less any cost of issuing the liability. The initial recognition means that at the time of initially recognizing the financial liability in our books of accounts, at which price we have to measure it. Say, for example, you have taken a loan. This loan is a financial liability. It's a financial instrument. Is it? At which price do you normally recognize a loan in your books of accounts? The cash proceeds which you are getting and any price which you are incurring in order to issue the liability is going to be deducted. So that net price, that fair value is the amount at which you have to recognize the liability in your books of accounts. What is an accounting entry at the time of taking a loan? Debit, cash, credit, loan. So which amount you have to write it in front of this accounting entry will be your initial proceeds which you are getting as a loan, less any cost of issuing that liability. Clear? This is the initial recognition. Then what is the subsequent measurement criteria? We do know that the liabilities or any of the financial instruments may be long-term in nature, may have to be recognized in our books of accounts for the period of more than 1 year. Say, for example, if you have taken a loan for 5 years, for 5 years, it has to be written in our books of accounts. So initially we have recognized it at the cost of issuing, the cash proceeds minus cost of issuing. Is it? But in the subsequent period, in year 2, year 3, year 4, year 5, at which price you are going to record it? You are going to record it at its initial value plus effective interest minus interest rate. Students, what is the difference between effective interest and interest paid? Effective interest is basically your finance cost. The actual finance cost which you are bearing is the effective interest. And interest paid is an amount which you have actually paid during the year. Okay. Interest paid is being calculated on the nominal value. Every time you are going to calculate interest paid on the nominal value. They are going to give you both the interest rates in the examination. They will be telling you the effective interest. Effective interest is the finance cost. What you write in your SOPL. Where does the interest cost goes? In your SOPL. Do you remember the format of SOPL? After writing profit from operations, PBIT, you do deduct finance cost. That finance cost is basically the finance cost which is calculated on the basis of effective interest. And one interest is the one which you are actually paying. So at this amount, initial value plus effective interest minus interest paid, the amount which you are going to get is an amount at which you are going to recognize your financial liability in your books of accounts from second year onwards. What is that? Initial value plus effective interest minus interest paid. So you are going to calculate the balance at the start of the year, effective interest and interest paid, and you are going to get the balance at the end of the year. That balance at the end of the year is the amount which you have to write in your SOFP from year 2 onwards. So they say financial liabilities will be carried at amortized cost. Students, this is known as amortized cost. When we are calculating initial value plus effective interest minus interest paid, it is known as amortized cost. Do you remember? No, you have not done F9. In F2 also, there has been a chapter of compound interest. Over there, calculating the present value. We have calculated one thing is IRR, internal rate of return. The same principle is applied over here as the same type of calculations we are going to do. Effective interest is basically a compound interest. That is a compound interest. Okay. So they say financial liabilities will be carried at amortized cost other than liabilities held for trading and derivatives that are liabilities, both of which are unlikely to be seen within financial reporting. So derivatives and liabilities held for trading are not going to be covered in this FR. The effective interest will be different to the interest paid if there are additional costs of borrowing, such as redemption premiums, issue cost, or discount on issue. An example of this type of liability is the deep discount bound. Now, effective interest and interest paid should normally be the same one. But the change is going to arise when sometimes we do say that at the time of redeeming the loan, we are going to pay some premium on that as well. Say, for example, we have taken a loan of 100, but at the time of redemption, we are going to pay 120. So if that is the case, obviously effective interest is going to be change once. So the example of this can be a deep discount bond. Basically, a deep discount bond is a type of the loan note which is being initially issued at a huge discount. Say, for example, the par value of a loan note has been 100, but it has been issued at 40% discount. So it means that it is being issued at 60. So you have given $60 and you are now in a position to claim 100 back at the time of the redemption. Is it? So it means that the amount which has been taken by the company as a loan is different to the amount which you are able to redeem at the time of the redemption. So when there is a deep discount bond, obviously the effective rate of interest and the actual finance cost will be the actual interest paid will be the difference. Anyhow, they have given an explanation of the deep discount bond over here. You can revise it by yourself. I have explained that what are deep discount bonds. We are going to do this illustration number 2, students, in regards to the financial liabilities. Show how the value of the loan note changes over its life. This is the basic example of financial liabilities. Show how the value of the loan note changes over its life. Loan note is issued for $1,000. The loan note is redeemable at 1,250. Now the redemption value is 250 higher. It means that effective interest and the interest paid will be different. Is it? Loan note is issued for $1,000. The loan note is redeemable at 1,250. The term of the loan is 5 years and interest is paid at 5.9% per annum. The effective rate of interest is 10%. Students, whenever you are encountering the questions in regards to the financial liabilities, you are going to make 4 columns for calculations. Balance at the start of year, then finance cost. This is a cost which you are going to write every year in your SOPL. It is going to be calculated at effective rate of interest. Effective interest. You are going to make a column of interest paid. And the amount of interest paid will be calculated on the nominal value. It means that after the redemption, it is going to remain the same. It will not change. And then the last column will be balance at the end of year. This is an amount which you are going to write in the subsequent measurement of the financial liabilities. From the second year onwards, this amount which you are going to calculate in this column will be written in your SOP. Okay? The amount which you are going to calculate in this column will be written in SOP. So loan note is issued for $1,000. It means that at the start of the year, the value has been 1,000. The loan note is redeemable at 1250. It means that at the end of the time period, when you are going to make a redemption, you are going to return it, you have to pay 1250. The term of the loan is 5 years. So for 5 years, it has to be paid 1, 2, 3, 4, and 5. The interest is paid at 5.9%. The interest paid is 5.9%. The effective rate of interest is 10%. This is 10%. Clear, students? Can you make the calculations now? Calculate interest paid. Interest paid will always be calculated on the nominal value. What is the nominal value? 1,000. 1,000 multiplied by 5.9%, 59. Is it 59? So 1,000 multiplied by 5.9%, 59. This interest paid will remain the same and will always be calculated on the nominal value, on the principal value which is being issued, not on the redemption value. Okay, so it will be 59. After 5 years, it will remain 59. So you can write 59, 59, 59, and over here also 59. After the end, it is going to remain the same. Then students, effective rate of interest, you have to calculate 1,000 multiplied by 10%. How much it is? 100. It is 100. So now you have to calculate balance at the end of the year. 1,000 plus 100. That is an initial value plus effective rate of interest minus interest paid. So 1,000 plus 100 minus 59, how much? 1,000? 1,041. So it is 1,041. This 1,041 will now become the balance at the start of the year. Is it, students? Now in the SOPL, how are you going to show it? You are preparing an SOPL. Students, because you will be required to show the things in the SOPL and SOFP as well. When you are going to prepare the SOPL for the first year, like this we can write. In the first year, the finance cost would be how much? 100. Clear? And in SOFP, in the first year, the liability at the end which you are going to show is 1041. Clear? Now students, second, 1041 has come. 1041 multiplied by 10%. How much it is? 104.1. Is it? 104 you are going to do. Sorry? 0.1. You can round it. Okay? 1041 plus 104 minus 59. How much it is? 1086. 1086. 1086 will become at the start of the year. Now 10% of 1086, 109 you can take. 109. So 1086 plus 109 minus 59. How much?
126.
1.
Oh, yeah.
1086 plus 109 minus 59.
126.
1136. 1136. Students, are you seeing that what is happening over here? This amount is increasing because ultimately what we have to pay 1250. Ultimately, it has to become that amount. Okay, 1136 is now the initial value. 1136 into 10%, it will become 114. So 1136 plus 114 minus 59.
1189.
1189. 91.
Yeah.
1191. It's okay, students. 1191. 10%. 119. So 1191 plus 119 minus 59. 1251. Students, now 1251 will ultimately be paid. 1251 plus 59 of the current year is going to be paid. At the end of the fifth year, we are not going to write liability because at the end of the fifth year, it is going to be paid. So at the redemption, 1250 is going to be together with the interest. This is why we calculate effective interest. Because at the time of the redemption, we are not going to pay 1,000. 250 has to be added. So it means that liability which we have to fulfill at the end of the fifth year must have to be recorded in all the previous years as well. Because in all the previous years, we are taking an advantage of this 250 extra amount. So this total amount will be paid at the end of the fifth year. It will no longer be our liability. So in SOPL, in the first year, our cost has been 100. In second year, 104. In third year, 109. In fourth year, 114. And in the fifth year, 119. Similarly, for SOPL, in first year liability is 1041. In second year, it's 1086. In third year, it is 1136. And in the fourth year, it is 1191. In the fifth year, no liability will be there since we are going to pay during the year. Cleared? This is how we are going to account for financial liabilities. If you are cleared about this calculation, trust me that the basics of the financial instruments are being clear. Okay? This is how you have to encounter the questions regarding this. Oh, the class timing is over? I didn't. Okay, now students, understanding number 1. We have a lot. Okay, we are going to do this from here in our next lecture. Okay? Try to do this understanding number 1 from your home, and we are going to start discussing it from here. The students, how many standards we have discussed up till now? IS 16 is being done. Then 14, yes, 20. Very good. IS 23. Then IS 8. Before this one, okay, only this. Then we have discussed IFRS 5. And
38.
then IFRS 9 and now 13 we have not discussed.
38.
38, yes, that's what I was thinking. Honestly. IS 38 and 36 also. Yes. 16 is being done. Oh. 32, these are the ones which are under consideration. IFRS 9, 32. Okay, students, this is all for today. If you have any confusions, you can ask. Do not leave the studies. Try to revise, otherwise in the end it will become very difficult. You people have to sit in your exams in June, is it? In June you have to sit. Do not think that in June you can skip the exam and then later you can do the examination and you will pass. As soon as you are studying, do give the exams at the same moment. Otherwise, obviously the concepts are going to be lost of your mind and be difficult for you then to cope up with. Okay, Angelika?
Okay, Miss.
And thank you, dear, for attending the class. Take care of yourself.
Okay, Miss. Bye, Miss.
Goodbye.